Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining me is Mark Phillips, CEO of Harvested Financial, to discuss trading around earnings. Mark, it's great to see you as always. Welcome back to Trade Talks.
Yeah, hi, Jill. Thanks again for having me.
And options expiration, of course, is coming this Friday, February 19th, but it's also earnings season. What's the interplay here?
Yeah, it's a really interesting time here. So we have the main serial February expiration that's coming up this Friday, but we're also right in the heat of earnings season. So we've got companies announcing before the market open, after the market close, and putting out all their quarterly earnings announcements. And so timed announcements like this are always particularly interesting for options traders. Options, of course, do very well with time and price levels. So when we think about earnings, that's a very known event that we have in the future, and that we can expect to see some action around that time. And it's particularly interesting when it's coming right in advance of expiration, because the movements that we're seeing in the options pricing is based exclusively on that earnings, that there's no other volatility or there's no other time factors. It's very concentrated around the actual event coming right into expiration. So as we see some of these companies that are announcing just in these coming days, it makes for some really interesting dynamics in the options markets. Of all the classes also that are out there listing, every single one of them is going to have an expiration on this Friday. So it's not like our regular weekly expirations. Every single name that has an option listed, all the way down to all 3,000 names, they are going to have options that are in play this week if they have earnings.
And Mark, what did the options market tell us about earnings moves?
Yeah, so there's a lot of really interesting things you can divine from the options markets. And sort of what I was saying before about how, the volatility and the is all concentrated around this specific event. So it does make for some really interesting pricing behavior, because if something's going to happen on this day in the future, well, we have to manage those option strategies going into that over time. And so when we think about how an option might move on average, say 3% a day, well, if we know that it's going to move significantly on this one day in the future, we want to maintain that value in the options pricing over time leading into that event. So actually, I'll pull up a quick chart to show exactly sort of what that looks like here. Just a very simple, this is actually sort of mocked up on Applied Materials that's announcing their earnings after the close. And on average, for a name that's around 50 vol, you'd expect to see it move around 3.7% a day. So that's all of these regular bars here. But then we have the earnings, and if you look just at the earnings move, it's expected to move a little over 7%, so almost double. But all of that's going to happen on that specific day, because that's when the company executives are going to get out and give some color and texture around their information, perhaps announce new projects. So what this shows is that if you track the way the straddle price is going to change over time, the straddle price in an earnings stock is going to be this darker green line above, and it's not going to move as much going into the event. So the straddle price on day 2, day 3, day 4 is going to be relatively similar. Whereas with a regular option, that might decay more gradually over time. But then we see a big drop at the end, of course, on day 9 after that, earnings announcement is out and all the volatility comes out, and we see a big change in price. So all of that, it's an interesting pricing question as we think about sort of decay and the options price over time. But it's also makes for a really active volume environment, because there's going to be a ton more liquidity, a ton more investors getting involved to trade this play that's happening at that specific time. One of the metrics we look at is the volume and the average daily volume for names. And for names that have earnings coming that week, they trade somewhere between 5 and 10 times as much volume as they do during the rest of the year. So we see a lot more activity in here. That generally means tighter markets. That generally means better ways for people to access the options trade. And they're going to get that move because, in reality, a lot of people come to the options markets for exposure to a specific move, whether that's defensive or offensive, to take advantage of that volatility crush that we were talking about there.
And Mark, if you want to trade, what are some of the best ways?
Yeah, trading around earnings, of course, a lot of activity in there, so it is a great time to trade. One of the most common ways to think about setting up an earnings strategy might be to compare how the historical volatility around earnings has happened relative to where it's implying right now. So, you can go back and look at some of those historic moves and say, well, this stock moves on average $3 around earnings, and the straddle right now is pricing it around $4. So that might be an opportunity where you might want to sell the earnings volatility, whereas if it's underpriced, that might be an opportunity to buy. So historical comparisons are a great way to start to think about that. If you want to go a level deeper and start analyzing relative volatility environments, that's another kind of layer that you can put on that analysis. So not only does it matter if a stock is $50 and moves $5, but it also matters what was the overall macro environment at that time. We tend to see in high volatility environments, earnings announcements of the same sort of magnitude will actually move the stock more because we're generally in a higher volatility environment. So adding another layer of analyzing the relative volatility environment lets you kind of position a little bit better and more granularly going into these earnings. I did talk about straddles there a little bit because that's such a great indicator for how to benchmark the expected move. I guess a quick recap, a straddle would be buying a call and buying a put at the same strike level. And that sort of option strategy we use to frame the expected move because that position would benefit directly from movement in either direction. You're not betting that it's going to be a good announcement or a bad announcement. You're just betting that something's going to happen. So while it's very interesting from an overall move perspective, it does expose the investor to unlimited risk. And at Harvested Financial, one of our important attributes and things that we focus on when we're setting up option strategies is defined risk. And this not only lets the investor know exactly what they're getting into at the time of the trade, but it allows them to kind of frame their overall risk management. So instead of actually buying or selling a straddle, one of the ways to modify that would be to do a butterfly strategy. So these are incredibly popular with options traders and particularly around earnings. But it looks like a straddle where you just cap it by buying the wings on either side is what we call them. So, that will limit your overall exposure, but still kind of keep you exposed to that earnings volatility crush if you're on the short side, or the actual movement if you're going to speculate on a large move. So using a butterfly with a defined risk trade structure is a great way to enter into that trade once you've sort of identified the opportunities, perhaps based on analyzing that historical, movement action there. So that's a great way to get into the position. But then overall, thinking about a portfolio approach is another good way to approach earnings trading. So, it's hard to pick any single one and say, this is how much it's going to move. But you'll want to think about putting your eggs across a couple different baskets and using a diversified approach so that, instead of just singling out one name, taking a couple different names, setting out take profit targets is a great way to sort of manage that basket approach and sort of staying systematically exposed to a variety of different earnings names lets you capture some of those differences that you've tracked through data. So overall, earnings are a fantastic time to get involved with the market. Lots of liquidity, lots of really interesting movement opportunities, and they're the known that something's going to happen this day. So great opportunity to get in there and trade.
All right, Mark, appreciate the insight. Thanks for joining us on Trade Talks, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.